So now we're moving into the financial focus portion of this webinar. So if you're looking for just the sequence of returns risk section, you found it. We've finished the weekly webinar portion. You're welcome to go back and look at that video or look at this, the previous parts. But here we're going to talk about sequence of returns risks and what happens if you have negative returns early in your retirement and what the effect can be of those negative returns and maybe how to overcome those risks. Because what if you just retired January 1st, 2025? I'm guessing you're feeling some anxiety right now about what we're seeing in the markets. It's, as I was just saying, it's a real roller coaster. We have some big highs and some really deep lows. And it's likely to continue for a while. We've got a lot of uncertainty going on. A lot of, many people aren't feeling a lot of stability or not feeling a lot of stability. So we're going to talk about sequence of returns risk. And if you haven't yet, if you're just joining us for the first time on YouTube, be sure to hit that subscribe, like, and notification buttons and be able to be notified when we have videos and stay on top of this, because this is education for you. This is not to be viewed as advice, but this is education. So what I'm doing here, I'm pulling you into a couple different past education events we've had. So the first is the Changing World of Retirement Planning. So this screen is right out of that. And this goes into retirement distribution pitfalls. And we're hitting pitfall number 3. That's why you see this. And this is sequence of returns risk. So sequence of returns risk means when the returns that you experience in different years in your retirement. So I'm going to run through that in a minute. And then I've taken this section with the approval of David McKnight, the person who wrote this course, The Changing World of Retirement Planning, and I've created an advanced class series. And I've run through that advanced class series many times for people who have attended the Changing World of Retirement Planning. And we'll do one. I think we're planning on doing one in the summer when we have a break of doing classes, because we do one in the winter, January, and then we have another one starting this month, and then we have another one in the fall. But I'll have a whole advanced class series sometime this summer. But so we're pulling a section out of the Changing World of Retirement Planning, and then I'm layering in a section out of our advanced class series where we're going to talk about how to potentially overcome these the sequence of returns risk, and how you can patch things up potentially in your financial plan and in your investment portfolio. So let's go through this. Sequence of returns. Sequence of returns is the order of your investment returns. It can be risky if negative returns happen in early years of retirement. Is less risky if negative returns happen later in retirement. Poor returns when coupled with withdrawals, right? That's the big deal here. Can do lasting damage to a portfolio. So David does a good job of comparing. I'm just going to just share the. I'm going to put myself out of here so I'm not blocking anything. But here's the example from the course. So 2 couples retire at the same time. So let me just give you a little foreshadowing here. What I'm going to do is we're going to take this information from the course, and then again, we're going to try to repair it. We're going to try to say, okay, well, what if we do this and this? How is that going to affect Tom and Mary? Because this is the example of Tom and Mary and Mike and Susan. Now, let me just again give you a little foreshadowing. You do not want to be Tom and Mary. We have 2 couples retire at the same time. Both are age 65. Both have $500,000. Both begin to withdraw 5% per year, adjusted for inflation at 3%. Both average a net return of 6% a year. Tom and Mary experienced negative returns early in retirement and positive returns later. Mike and Susan experienced positive returns early in retirement and negative returns later. So now let's go into this and let's look at this a little bit. So we've got Tom and Mary on the left here, and they start with their balance of $500,000. So why $500,000? Well, that's what's in the course. So we're going to work with that number throughout this series here. So they start at $500,000. They have a negative return in that first year, negative 27%. Have we seen negative 27% before? Well, we sure have, right? The next year, so they have to take out the $25,000. and then they end with $346,000. So they take their withdrawal plus their loss, and that's what they end with, $346,000. Then next year they have another negative return, negative 16.5%. They have to take out their $25,000 plus a little bit for inflation, $25,750. Well, now they're down to just about half. You see this here? I've got my laser pointer, $267,638. I hope you can see that well. I'm hoping at this point they're having a conversation with their financial advisor, and their financial advisor would probably say what to them at this point? Stay the course, right? Maybe they'll say, well, heck, the market was down 20% last year, and you're only down 16.5%. So you're doing really great. But the problem is that staying the course might be detrimental. So then we go to the next year. So it's not so bad. The next year they're down negative 1.9%, and they're at 26,523. That's what they have to take out now because of inflation, 26,523, and they're all the way down to 236,000. So now what happens? Well, geez, they do okay. They have a positive 3.1%, positive 10.9%. They're negative one more year here at negative 9.4, but they're positive 7.4, 8.1, 15.4, 9.4, 6.2, 12.4, 2.8. Uh-oh, what happens here? That's zero. So I always joke and say my official CFP opinion is zero is no good, right? Zero is no good, especially at age 78. That zero means they've burned through all of their money. They've burned through all their money. Now what are they going to do? Well, can they go get a job at 78? Maybe. Can they do something a little different? Well, they don't have any more portfolio to work with, so something should have been done along the way. Now that is sequence of returns poor, then strong. That's poor returns early and then strong returns later. But look, when we get down to these stronger returns, even these strong returns, it's not enough to make up for what we've done in the beginning. And we see a lot of people get stuck in this. They have negative returns. Well, I have a commitment to my financial advisor. I'm a loyal person. He or she says everything's going to be okay. Wouldn't make any changes. Just stay the course. And then by the time you're fed up and you move half of your money or to do something different, it may already be too late. So you've got to be as ahead of this as possible. Because look at Mike and Susan over here. They have strong returns in the beginning, then poor returns later. So their first year, they're 26.7, 10.1, 4.3, 8.9, 17.6, 22.5. They don't hit a negative year until they're 72 years old. They're taking out the same amount of money as Tom and Mary. Remember, they both retired with the same amount of money. They both, at the same time, same amount of money. They both withdraw 5% a year adjusted for inflation at 3%. They both average 6% a year. Tom and Mary experienced negative returns early in retirement and positive returns later. Mike and Susan experienced positive returns early in retirement and negative returns later. So everything is the same except their sequence of returns. So this is what that means. This is graphically, or this is showing you exactly what sequence of returns means. Now, I'm sorry if you're listening to this on the podcast. I'm just going to refer you back to this video because this is very, very visual. And my son who does my editing says, it's kind of annoying that if you're listening to the podcast to have to flip back, but I don't know how to do that for you. So, or I don't know how to overcome it from the podcast. But what we're seeing, let me just describe maybe a little bit what we're seeing is. We're seeing a spend down, a very, very fast spend down between two couples, Tom and Mary, Mike and Susan. And as I said, Tom and Mary run out of money by age 70, 78 years old just because of something that is out of their control, and that's market risk. They experience negative returns earlier in their retirement and some positive returns later, but by the time that happens, it's too late. And at age 78, on the other side, Mike and Susan, where they have positive returns earlier and negative returns later, by the time Tom and Mary are out of money, Mike and Susan have spent the same amount of money, actually a little bit more because they still had it. And they're at age 78, $1.1 million. So let's just pause there for a second. I'm going to drop my highlighter right there. Well, who would you rather be at age 78, Tom and Mary or Mike and Susan? 0 or $1.1 million? Well, that is a kind of a slap in the forehead, duh moment. Of course, you'd rather be Mike and Susan, but you've got to be able to really time the market. So this is a really good example, and that's why I like to use this. Thank you, David McKnight. This is why I like to use this, because this is a great example of sequence of returns risk, because you'll see this just continues. And Tom and Mike and Susan don't hit negative returns till throughout the time, but it really starts much later. And they still have money at age 95 when presumably they both pass away. In fact, they have just about $1 million, $980,350. And obviously they've spent considerably more because they still had money to spend. Now, the other thing that's similar to between Tom and Mary and Mike and Susan in both scenarios, not just their age, their starting amount, their average return, because both couples averaged 6% a year. That's why one of the things that really I like to talk about when we're talking about average returns, it doesn't really matter. It's good. It's one thing to look at. What's the average return been of this mutual fund over the past 20 years? But that's your timeline is much different than the timeline of that return average. I hope that makes sense. And you can average a 6% return, but still be devastated in your retirement portfolio, like I'm showing you here, if you're not protecting yourself, and if you're not taking the steps. This is basic. This is just using basic asset allocation. And asset allocation, as I said in the first part of the weekly web or this first part of this broadcast, is vitally important, but holds tremendous risk if that is your standalone answer to retirement funding. So you'll see that the other thing that's exactly the same between Tom and Mary and Mike and Susan is that not only are their average return the same, but their returns are actually exactly the same. They're just turned upside down. So negative 27.1 in the first year, negative 27.1 in the last year, negative 16.5% in the second to last year, negative 16.5% in the second year, compared to the two couples. So they're the same exact returns, just flipped over. So that's a really good example of what sequence of returns risk. Now, what I did from here to say, okay, well, how can we improve upon this? And the first thing is using principal protection. So the second of our core strategies are pillars, our three pillars. So our three pillars are, and we're going to just include this in this video too, like I do almost every week these days. There's been a lot of market volatility, so I talk a lot about our three pillars of investment management, and you can say it with me: asset allocation, principal protection, and account segmentation. So let's talk about principal protection. So the first thing that we do, let's just retire this pointer for a second, is we erase the negatives. So go back, remember, negative 27.1, negative 16.4. Well, now we've made them, the negatives, zeros. So if you're following along here, what I've done is highlight it in that first section. The negative, we've just made the negative returns zero instead of negatives. Now, the other thing that we've done, if we're just using principal protection, you'll see that when we go to the following years, so let's go up here to age 69. And in comparison, we've reduced the return because we're giving it a smaller average return to make up for the principal protection. Because typically when you add principal protection, you do reduce your average return, but it still can have a positive effect on your overall experience in retirement. I hope that makes sense. So the first thing we've done is we've removed the negative returns here. So you'll see all those negative returns have been removed. Now, what we've done here, just by removing the negative returns and even by reducing the overall average, we've taken Tom and Mary from running out of money at age 78. Remember, they were out of money. Their dollar amount that they had at age 78 was zero. Now, by just putting in principal protection, they now have $242,000. Well, that's going to carry them for many more years. And in fact, that takes them all the way to age 86. So that is very good. So using principal protection adds a lot of years, just about 8 years, or exactly 8 years for this couple. Now, everybody does the first pillar, right? Asset allocation, whether you're doing it yourself, whether you're doing it with a professional, whether it's a thought out asset allocation driven by some kind of science, you have some level of asset allocation. There are many people that will deploy principal protection. Probably about, I would say, maybe half the people who do what I do, certainly independent people, not the people in the big firms. They're mostly, focused on just the investment management, but many people will use principal protection in some form. But you'll see that doesn't get you all the way. This is still a failed plan. Tom and Mary have to die at age 86, before age 86, or they're running out of money. And it gets significant, right? So that's still a failed plan. So from a financial planning point of view, we just using principal protection, we have some answers. Okay, well, what if you worked a little longer? So follow over here to this second column, or this second section, and we said, well, what if you worked a little longer and you delayed your withdrawal? So instead of taking that $25,000 out at age 60, your first withdrawal at age 66, we take it, you don't take that until age 70. Well, we still remove the zeros using principal protection, but if we delay the distribution, because a lot of people say, can I retire at 65? And sometimes the answer is yes. Sometimes the answer is, well, you could actually retire now if you really wanted to. And sometimes the answer is, well, you might want to work a little longer because your money is likely to last longer. So now, just using that delayed withdrawal strategy, we're still adjusting for inflation in that first year. We take that all the way to age 90. Now, 90 is the first year where we're seeing a negative there. I hope you're following along there. So that's better. We're getting there. 86, 90. Now, some people will say that's good enough. Some planners will say, well, geez, age 90, that's okay. You may not make it to 90. Well, you've got a chance that one of you might if you're a married couple. So that's not good enough for us. We project our plans out to 95, but if we were showing a negative return at age 95, I would not feel comfortable. And even in the next scenario I'm going to share with you, I still wouldn't have a level of comfort there. Now, the next section here, again, we're going to zero out the negatives. And what we did here is we delayed the withdrawal even further. If the one of the couple or both of the couple were willing to work until age 74, I know that's a lot longer, that solves it. We've zeroed out the negatives, which means any negative, we've just made a zero. Let me back up there. Principal protection means your worst return in any given year is a zero return. Is a zero return better than a negative return? Well, that answer is yes. You have to, of course, look at how it affects the entirety of your plan and your return, because it does. It certainly does. But you can see here, even though we've reduced the average return down to just about 4% over that time instead of 6%, even just with principal protection, we added 8 years. If with principal protection and delaying the withdrawals, well, we've added 12 years. With principal protection and delaying the withdrawal even further, we've taken them out to a quote unquote successful plan. So that's the strength of principal protection. Now, we're just building on here. I don't, having a discussion with a client about maybe working another 5-6 years is one thing. Having a discussion with a client about working another 9-10 years is a completely different animal there. And it has other risks involved in it. We have mortality risk. We want to make sure we want to enjoy the end of our life, or the retirement part of our life, and not be working maybe as much or at all during those years. So there may be other things we can do. So let's talk about the next step, because again, 100% of you and your financial planners, if it's not us, includes us, have asset allocation. Asset allocation is important. That's pillar number 1. Principal protection is vital for most people. That's and I just explained that. So that's your worst year is 0, not negative return for the amount of money you have in that principal protection is 0. Maybe about half of the people who are independent financial planners also use principal protection. Very, very few people use this next strategy I'm going to share with you, called account segmentation. The reason is that it is really time consuming. It is very labor intensive. There are just a handful of us in the country, and if you've heard our analyst talk, he works with other our investment analysts. He works with many firms around the country, and he has said publicly, nobody. A lot of people talk about segmentation. Nobody does it like the way we do it completely. So let's talk about it. So this is typical asset allocation. This is how the conversation usually happens with a typical financial advisor. And when I say this, listen, folks, I'm not beating up on other financial advisors. There's reasons maybe they don't know about these strategies. One of our planners that we brought with us, and I'm going to have on a webinar soon. We hired from Vanguard. He was at Vanguard for 11 years. He's learning our strategies really quickly. By the way, he's doing a great job. But he'll tell you. He said we didn't have the time and the resources to do this kind of work at Vanguard. It's not a knock on Vanguard. It's just different. We're a boutique firm. We have a much smaller client base, and we really dig in and take the time. But typically, this is how it works. Your advisor or planner will determine an asset allocation using some kind of tool, whether it's an unsophisticated tool or a sophisticated tool. And they'll determine what your risk tolerance is from a scale of 1 to 10 or 1 to 100. What you have in front of you is a tool that tells us from 1 to 100 what your risk tolerance, how much risk you're willing to take in any given year on your investments. So this shows a risk of 35. That's pretty low. Most people come in at 5 or 6, or if we're going 1 to 99 or 1 to 100, then it's a 50 or a 60, 65. Most people are more in the mid-range. But this is an example, a true life example. This goes back. Now you can see here, this goes back to 2019, but that's using a risk score of 35, which is pretty darn low. And that shows that over the next 6 months, you're comfortable risking $74,000 or gaining $127,000. So that depends on your level of risk. But that's typically how portfolios are built. So now what they'll do is they'll say, okay, well, this is your current asset allocation. This is where you currently are. And then we have this target asset allocation. And we're going to take you from where you are, and we're going to bring you to where you should be based on your risk analysis. That's really common. And then it just kind of is monitored from there. So they'll take that score, and you'll end up with something like this. And then the idea is they'll say, okay, well, here's your retirement, right? And here's the start of your retirement. And here's the time when you're no longer here. And all of this one asset allocation based on this risk tolerance, and maybe that risk tolerance is adjusted every year. It should be, but it could also change. Your risk tolerance at the end of last week or at the beginning of the year. Let's go back to the beginning of the year. Or the first part of the year, your risk tolerance may have been a 50 or 60, more aggressive. I can take some risk in my portfolio. After what we've been through over the past 30 days, maybe you'd be at a 35. Say, whoa, wait a minute. But the problem here is that most people look at this funding for 30 years and they say, for the next 30 years, I've got to rely on the withdrawals from this portfolio. And there's a couple things that happen. The first is what I call the worry zone. Whether you're going into retirement, maybe the 3 years before retirement, 3 years after retirement, you hit this worry zone. And you say, my gosh, I am so worried. I'm used to being a saver and a spender. I've got money coming in. I spend some, I save some. And now I'm just going to be a spender. Suddenly that cash flow is not dependent on somebody else. It's all dependent on me. You're not getting it from your employer or from your business. You're getting it on me. It's all from you. So you got to overcome that worry. And then we have this other thing. So many people know what this means, this FOMO or FOMO. That's the fear of missing out. Because if you go too far the other way, like a 35 risk level or even less, some people say, I don't even want to be involved in these crazy markets. Put me all in CDs. I'm still getting 4.2% in CDs. What's wrong with that? Well, at some point, I can promise you that your human nature is going to step in and you're going to say, geez, if I just would have invested in whatever, then I would have had so much more that I could live off of or give to, leave to my heirs, whatever your objectives are. And that's that fear of missing out. And it does happen. There's another part of it is that we've got this thing called inflation. There were times when I was reminding people that we had this thing called inflation, but geez, we all know about it now. So not only do you have the fear of missing out, but you also have that inflation that you have to take care of because things are going to cost more in the future. So the only thing that's been proven to help you stave off inflation is growth of your investments. And the only way to truly grow your investments is to be exposed to these crazy markets that we see. But there's ways to manage that risk. So what if we do it differently? So what if instead of we were going to take one portfolio and plot it out on a 35-year timeline and we're going to say, trust us. Why don't we break the timeline down to different, what we call segments? This is where account segmentation comes in. Segments. So we have segments at time. So this is an example of 1 to 3 years. Your first part of your retirement is 1 to 3 years. Second part is 4 to 6 years. Next part is 7 to 9 years. And then after that is 10 plus years. So I'm making this very, very simple. And when we have our segment 1 account, right now it's 50% money market, 50% U.S. Treasuries. Now, if you're listening to this a year from now, our allocation might be different. But sitting here, April 30th, 2025, that's where it is today. And then when we go out to our segment 2 accounts, so segment 2, that's where you see that years 4 to 6 typically, that's 60% bonds, 40% stock. And where we have stock exposure, we use some investments that offer some downside protection as well. Segment 3, we're at a 60% stock portfolio, 40% bond portfolio. And this shows 10 plus years. We usually go out further in segments. So that would be segment 4, segment 5, and then what we call legacy longevity. But you're seeing this instead of just saying, okay, one portfolio is going to cover our life. We plot out different types of portfolios with different risk levels for each time of your life. So now let's look at the next 3 years. If we determine that you need $75,000, so this is Tom and Mary's money, right? I took that example that we went through, Tom and Mary. Tom and Mary need $75,023 in today's dollars. We're going to have some interest earned, so we'll cover those needs. So this is net present value from a financial planning term. We're not putting any of that at risk. We're covering their next 3 years because if the market drops 30% or 27% like they experienced, they're still going to have that $75,000 sitting there. So that means that the other funds that are invested as we go out on that timeline have the opportunity to recover. The difference between now and 10 years ago, or a little longer ago, think about the Great Recession. So the difference between now and 2008, 2009, 15 years ago, is that you are now 15 years older and you don't have the time to recover. So what we want to do is we want to give you those 15 years back. We want to give you that time to recover. It's very, very important. So we're going to spend down to $75,000 over the next 3 years, and then we're going to replace it with segment 2. So we know in segment 2 here, we need $122,000. That's Tom and Mary's money. That's what they need over that time. And we're going to put that in a segment 2 portfolio. It's going to be 60% bonds, 40% stock, and we're going to manage those. And these are separate accounts. They must be separate accounts because, again, we're feeling and thinking human beings, and there are times that our emotions get right in the middle of our financial planning and investment strategies. And you have to be able to point to this account and say, hey, Tom and Mary, I know it's a really difficult time, but your next 3 years are coming out of this account right here that ends in, for example, 3789. For the next 3 years after that, we've got this account here that's going to have very, very little fluctuation. And this account, I can point to it on the screen, ends in 3780, for example. And then we fan out along the way. And then we have our different segments. And you can see then our most aggressive portfolio is for years 10 plus. And in Tom and Mary's example, we have $121,000. So now for full disclosure, Tom and Mary's example is $500,000. Us at Attleboro Wealth Management, we typically work with clients with $1 million and above. So just keep that in mind. I'm happy to answer questions, but if it's time you want to schedule, that's the type of client that we work best with. And it's not an elitist approach, folks. It's just because of all the time that we put in. But you can see how most people look at this and they say, Oh, that makes sense because you know exactly where your money's coming from. You know the risk level taken for each one of those accounts, and that's what we call account segmentation. So now let's look at what this could mean to Tom and Mary, because not only principal protection, removing the negatives and having zeros for at least a portion of their portfolio, but now also layering over account segmentation. Now let's look at where we are. So this is a real life example of the portfolio as I just shared with you, but in this example, we go out to all the way segment 7. So you see here that this $75,000 is spent down. I think I can come back to you. Yeah, there I am. The $75,000 here is spent down over this 3-year period. Segment 2 is a little longer. It's a 4-year period for Tom and Mary, and sometimes it's 3, sometimes it's 4. So they start with 122,000 and they draw that one all the way down, and then we come back in here to 73,000 and they draw that one down. Now they've got $53,000 here in segment 1 that we want to start with, but that's going to grow to $129,000 by the time we need it. So we draw that down, and then we continue. Now I want these segments continue to be brought down. Now let's look at how long we made Tom and Mary's money last. Instead of age 78, them running out of money, by just using the principles of proper asset allocation, principal protection, and account segmentation. Now, using the same withdrawals, using the same starting point, the only thing that's changed are the methods. That is 98 years old. So if you're just listening to this in the podcast, what we've shown you is just by using proper financial planning methods and their Attleboro Wealth Management method of account segmentation, we've taken a disastrous situation for Tom and Mary where they're running out of money at age 78 years old to being fully funded until 98 years old, and actually 97 years old. So I'll just ask you, which is better? Well, certainly 20 more years or 19 more years of your funds is better. So that, in a nutshell, is the strength of the 3 pillars: asset allocation, principal protection, and account segmentation. We talked about how important the risk of sequence of return risk is. I showed you the comparison between the 2 couples, starting with the same amount of money, the same average return, the same amount of withdrawals. One had money left at age 95 years old. One ran out of money at age 78 years old. And you might throw up your hands and say, well, I can't control these markets. You can't control the markets, but you can control how you manage your investments appropriately along with your financial plan that should be reviewed every year using the principles I talked about. So I hope that was helpful. I look forward to seeing you all again soon. Again, no webinar next week. I'll be back the following week. If this is your first time, or if not, and you haven't subscribed, please hit the subscribe, like, and notification buttons. I'd love to see you again. Tell your friends if you enjoy this YouTube channel or the podcast. And if you have questions, you can reach us at questions@attleborowealth.com. That's questions@attleborowealth.com. And otherwise, we will see you next week. Have a great week, everybody. Take care.